Welcome to FlashCore, your sharpest source for daily headlines and deep dives. If you're new here, don't forget to hit that subscribe button and stay ahead of the curve. The global economy is shifting in ways we haven't seen in decades, and the once stable financial relationship between the United States and China is unraveling before our eyes, sending ripples through markets everywhere. For decades, China financed America's spending by buying U.S. government debt, acting as a crucial lender and stabilizer for the U.S. economy. But that era is ending, and the consequences could be profound. As trade tensions and geopolitical rivalries grow more intense, China is quietly reducing its U.S. Treasury holdings, a move with global consequences that could reshape the financial landscape. This isn't just about numbers on a balance sheet. It's about power, leverage, and the future of the world's financial system. The big question looms. What if China dumps its U.S. debt all at once? Could it spark a financial crisis in America, sending shockwaves through global markets? And what would it mean for China's own economy and ambitions? Other nations are watching closely, and some, like Ontario, Canada, are seizing the moment with bold new strategies to protect their own interests and capitalize on the uncertainty. We'll break down why China became America's banker in the first place, and how this relationship shaped the modern global economy. We'll explore how the trade war weaponized this financial connection, turning economic ties into tools of influence and risk. And we'll examine what a massive sell-off could mean for everyone, from Wall Street to Main Street, and from Beijing to Berlin. Then we'll look at Canada's ambitious $632 billion plan to reshape its own financial future, and what it signals for the new economic order that's emerging as old alliances shift and new players rise. The era of predictable global economics is over. Competition, uncertainty, and realignment are the new normal for nations everywhere. The actions of the US, China, and proactive players like Canada are redrawing the map of global power, setting the stage for a new era. Let's dive in and see what's really at stake as the world's two largest economies begin to untangle their financial destinies, and as new contenders step onto the global stage. To understand today's standoff between the world's two largest economies, we need to look back and see how China became America's top creditor and why that matters so much today. Over the past few decades, China's manufacturing boom transformed the country into the world's factory, creating a massive trade surplus. This left China with mountains of US dollars, earned from selling everything from electronics to clothing to American consumers. The safest and most reliable place to invest all those dollars? U.S. Treasury bonds, essentially loans to the U.S. government, backed by its promise to pay. This arrangement benefited both sides. China got a safe, stable investment for its growing reserves, while the U.S. gained a steady, dependable lender to help finance its government spending and budget deficits. By buying up U.S. debt, China also kept its own currency, the yuan, weak compared to the dollar, making Chinese exports even more competitive on the global market and fueling further economic growth. The cycle was set. China lends to the US buys more Chinese goods, and both economies become increasingly intertwined and dependent on each other. Over time, China's holdings of U.S. debt soared past $1 trillion, giving it real financial leverage and a powerful stake in America's economic stability. But this deep interdependence also created vulnerabilities. The U.S. came to rely on Chinese capital to fund its spending, while China depended on American consumers to keep its factories running and its economy growing. This delicate balance worked well in times of peace and cooperation, but it was always at risk of being disrupted by political tensions or economic disputes. Now, as global tensions rise, that risk is front and center, reminding both nations just how much they have to lose. The US-China trade war shattered the era of quiet cooperation. Tariffs flew back and forth, disrupting global supply chains and fueling uncertainty. Some speculated China could weaponize its U.S. debt holdings, selling them off to destabilize American markets. A massive sell-off could spike U.S. interest rates, making borrowing costlier and slowing the economy. But it's a double-edged sword. China would suffer huge losses and a stronger yuan, hurting its own exports. That's why China hasn't gone nuclear. Instead, it's gradually reducing its US debt exposure. This slow de-dollarization is a strategic pivot, not a sudden attack. The goal: reduce dependence on the US financial system and insulate against American pressure. Quietly, this is reshaping the global financial landscape. Imagine a scenario where China suddenly decides to sell all its US debt, over $760 billion worth of Treasury bonds, almost overnight. This move would send shockwaves through the global financial system, as China is one of the largest foreign holders of US government debt. The bond market would be thrown into chaos, with prices plunging rapidly and interest rates soaring as investors scramble to adjust. Panic could spread across trading floors, with uncertainty fueling even more volatility. The US government would suddenly face much higher borrowing costs, adding billions, possibly even trillions, over time to the national debt. Funding everything from infrastructure to social programs would become more expensive. For everyday Americans, this would mean mortgage, car loan, and credit card rates would all jump, making life more expensive. Monthly payments could rise, and qualifying for loans would become harder. The economy could tip into recession, with job losses, business closures, and widespread financial hardship. Consumer confidence would likely fall, and spending could slow dramatically. But China would also take a hit. Its remaining US bonds would lose value, and a stronger yuan would hurt its exports, making Chinese goods more expensive abroad and potentially slowing its own economy. In reality, the US might weather the storm better than many expect. The American financial system is large and resilient, with deep pools of capital and a history of overcoming shocks. Other buyers, like Japan, European investors, or even US pension funds, could step in to buy the bonds, though likely at higher interest rates, helping to stabilize the market over time. The Federal Reserve could also intervene, buying up bonds to stabilize prices and keep interest rates from spiraling out of control using its powerful monetary tools. A sudden Chinese sell-off would be a major shock, but the US financial system has defenses and mechanisms in place to absorb such blows and prevent total collapse. The fallout would be global, affecting markets and economies everywhere, but it wouldn't necessarily be catastrophic. The world's financial system is interconnected, and adaptation is always possible. A financial clash between the US and China would hit home fast. If China sells off US debt, borrowing costs would spike. Mortgages, car loans, and credit cards would all get pricier. Homeownership could slip out of reach for many, and the housing market would slow. Small businesses would struggle to get loans, stalling growth and hiring. The stock market would likely tumble, wiping out retirement savings and shaking consumer confidence. The US dollar would weaken, making imports, from electronics to coffee, more expensive. Inflation would eat into paychecks, reducing purchasing power. Everyday Americans would feel the squeeze in their wallets and job prospects. This isn't just a headline, it's a direct hit to family finances. The ripple effects would slow the entire economy. In a globalized world, no one is insulated from this kind of financial fallout. As China reduces its US debt, it's betting big on gold. China's central bank has been quietly stockpiling gold, building trust in the yuan. The goal: make the yuan a credible global currency and challenge the dollar's dominance. By backing the yuan with gold and promoting it for international trade, China is building an alternative financial system. It's also developing its own payment networks to bypass US-controlled systems like SWIFT. If more countries use the yuan, global demand for the dollar drops, weakening US influence. This is a long-term play. The dollar's dominance won't vanish overnight. But China is laying the groundwork for a multipolar financial world. By pairing the yuan's rise with gold's stability, China is signaling its intent to reshape the global order. The world is watching as China makes its move. America's greatest strength, the dollar's reserve status, now comes with a risk: its massive national debt. With debt over $33 trillion, investors may start to question America's ability to repay, demanding higher interest rates. This could trigger a debt spiral, crowding out spending on priorities like defense and education. China sees this vulnerability as an opening to challenge US dominance. By highlighting U.S. debt and promoting its own financial systems, China is courting the developing world. U.S. sanctions have also pushed countries to seek alternatives, accelerating de-dollarization. Ironically, America's debt and sanctions are fueling the very movement that threatens its supremacy. As the US and China clash, other nations are seizing new opportunities. Ontario, Canada, has launched a $632 billion plan to transform its economy and attract global investment. The focus: clean energy, advanced manufacturing, AI, and critical minerals, sectors that will define the future. Ontario aims to build resilient supply chains, especially for electric vehicles and batteries. As Western nations look for alternatives to China, Ontario is positioning itself as a reliable partner. With stable politics, skilled labor, and natural resources, it's ready to supply the US and Europe. This strategy could create thousands of jobs and make Canada a key player in the new global economy. Ontario is betting on opportunity, not crisis, in a fractured world. We're at a turning point in global economics. The US-China relationship that shaped the last 30 years is unraveling, and both sides are recalibrating. China's debt sell-off, gold accumulation, and push for the yuan are all part of a strategy to challenge US dominance. The US faces tough choices: manage its debt, rethink its use of the dollar as a weapon, and adapt to a multipolar world. China's path is risky. Its economy still depends on exports, and the yuan has a long way to go. Meanwhile, Canada's bold investments show that new players can thrive as old alliances shift. The lesson: as old ties weaken, new opportunities emerge for those ready to adapt. The decisions made now by America, China, and Canada will shape global prosperity for decades. The world's economic map is being redrawn right before our eyes.